Good evening. The U.S. Federal Reserve has raised its key interest rate by 25 basis points, bringing rates to their highest level in 22 years. With the latest decision, the rate gap between South Korea and the U.S. is also at a record high. Now, eyes are on how this will affect the $1 exchange rate and the capital market, and what will be the Fed's next decision. For more, we're joined by Song Soo-young Professor from College of Business and Economics at Chung-Ang University and Professor Hwagyun Kim from Mays Business School at Texas A&M University. Welcome to the program.
Thank you for inviting me.
Good evening. Now, Professor Song, I want to start with you. The latest decision brings the key interest rate to a target range between 5.25% to 5.5%. Now, we know the rate hike campaign is all about curbing inflation, but the Fed has taken its 11th rate hike amid signs of inflation rather easing. Now, what would you say is the reason behind the decision?
Yeah, particularly the policymakers, they want to make sure that they would like to put down the demand enough to put an end to rapid price increases, because high inflation clearly is bad for the economy, particularly for some low-income people. So currently the inflation is decreasing, but they are not sure about whether it is as a fixed trend, and they would like to maybe prefer to avoid the plunge in the economy into recession. So if they can avoid it. So therefore, it is like some balancing act between in order to while avoiding the recession and then maintaining the current labor market, resilient labor market, and the GDP growth rate. So that's why they would like to, as they say, they have announced, because at least twice increase in this year, and the first one is realized yesterday. Therefore, I think currently this is a very balancing act.
Right, Professor Song pointing out the balancing act. Now, Professor Kim, in his previous meeting in June, the Fed had hinted that there will be 2 more rate hikes to come this year. Now, but markets were closely watching for signs that this could be the last before the Fed finally takes some break before it sees the economy kind of absorbing the impact of its past rate hikes. Now, we wonder, are we seeing an end in sight in near future?
Well, it's possible, but the scenario is there, but uncertainty regarding inflation is yet to be resolved. I think the rate freeze is going to depend on new data releases till September meeting. And I think the Fed really wants to convey the strong signal this time that inflation should go back to 2% level, both, I think, headline and core. So in that sense, probably it's a bit early to say that, but clearly the possibility has increased to this rate freeze. To give some perspective, the interest rate is typically the sum of the real interest rate and the expected inflation, and then core inflation has been around 5.6 or 7% in the very early of this year, but it went down to 4.8%. So on average, it's now about 5 to 5.25%. So this is slightly lower than the new target of 5.25 to 5.5. So we can see that some actions of constraining the economy to cool down the inflation is going to work, because the real debt burden is definitely in positive territory. Therefore, the Fed, I think, is expecting that it's going to cool down the inflation further. And if this is going to continue, then in September, after some new data releases, they may just freeze the data, the target, and then they'll see what happens. Otherwise, there's still a chance that interest rate actually could go up a little bit.
Sure.
Right. Well, Professor Song, in the meantime, Fed Chair Jerome Powell is staying kind of vague, saying there is still a long way to go to hit the Fed's target of 2% of inflation rate, while also leaving some room of a rate freeze. But Powell did emphasize that the next move will be driven by data and will be a meeting-to-meeting basis. Now, what is it that the policymakers will take into consideration for its next meeting in September?
Yeah, I think of course, Professor Kim has emphasized that data-driven policymaking is necessary, and currently Professor Kim emphasized that the core inflation rate has remained on average 5% or something. But I would like to say some supercore inflation rate is almost 2%, particularly because used car price and some food price is very volatile. Of course, recently the development in the Russia and Ukraine war may have some problem on the food price, but that is not the main threat because the policymakers, particularly in Fed, they are concerned about in March because of some problem in the financial industry, such as the Silicon Valley Bank bankruptcy and other problems in Credit Suisse in Europe. So they expect some recession, but right now, as the labor market resilient remains, the GDP growth rate is relatively robust right now. So to that regard, then they are very, their prospect about the future is maybe the soft landing is possible, but inflation clearly, of course, we may see that some forecasts or expectation of inflation of the upcoming next half of the 2023 will be most likely to be revealed in the speech in the Jackson Hole meeting and at the end of August. So in September, they are going to gather all the data and they will determine particularly whether to hold off the interest rate or raise one more rate. But however, I would like to say that particularly the vacancy rate and unemployment rate in the United States. So what I'm interested in is particularly the United States from the vacancy rate has been dropped from 9% to 6%, whereas the unemployment rate remains very constantly 3.6% for the past 14 months. And the variation of just a 0.2% variation. Therefore, I would like to say these kind of the beverage curve, considering this beverage curve, maybe we do not put much weight or much concern on the inflation. So we have to wait and see because at least we have 8 weeks until the next September meeting. Then most likely to be I expect the holding off the interest rate.
Right, Professor Song, you mainly touched upon the local conditions, but I wonder, there also the suspension of Black Sea grain deal between Russia and Ukraine, and also there's concerns over climate inflation with parts of the world seeing record temperatures affecting crop prices. Now I wonder, are you seeing any impact coming from those factors?
Yeah, food price clearly affects the inflation, but however, it's very volatile, and then it should not be treated as some trend factor or permanent factor. That should be transitory factor. So as long as those factors are treated as a transitory or temporary one, the government should rely on some kind of fiscal policy or subsidy to the poor people, low-income people, and then even maybe put the pressure on the corporation or companies, food companies, to increase the price, and because they would like to enjoy the benefit of the price gouging. Therefore, as long as it's a temporary one. But from my perspective, in European nations, European countries, they would like to stop and not to continue the Ukraine-Russian war anymore, not to extend further next years, because that caused really damage to the European economy. So I expect the Ukraine and Black Sea problems of the food import and export is maybe I expect a temporary one.
Right. Shifting gears in the meantime, Professor Kim, the world is also closely watching two other major rate decisions coming from the EU and Japan all this week. The two central banks have been going in rather opposite directions now. What are we expecting from them this time?
Well, to some give background, I think in case of the ECB, the council increased the interest rate by 25 basis point in June. And their deposit rate, I think, is 3.5% as of now. And ECB expects the inflation is going to cool down in 2023 and 4, but obviously European countries, especially Germany, has bad memories about inflation. So they want a little stronger sort of stance on the inflation curbing. So it's likely that I think they will increase the deposit rate to 3.75 to even 4%. The issue, I think, is the real economic activity is struggling. Therefore, unlike the U.S., and the labor market is not very good. So depending on their ability to increase the interest rate, they want to increase, but I think still it's a bit uncertain because of their real activity struggling. In case of Japan, as you mentioned, it's a bit opposite in that the Bank of Japan has been holding the short-term interest rate at the negative rate, which is the minus 0.1% in June. And it's been like that since like 2016 and 17. So they're clearly trying to stimulate the economy because they were in somewhat stagflation, the level. And they're kind of getting out of it, but still it's not for sure. And therefore, just because the inflation slightly went up, it's a somewhat unexpected increase, but most of the experts in Japan expect that this is going to be temporary and it's going to still go down. So I believe the Bank of Japan wants to maintain the low level of the interest rate, super low level of the target. If they still think that inflation is not cooling down enough, then maybe they'll try to touch upon their long-term target. So they're using actually both short-term target and long-term target. So maybe they will drop the long-term target if inflation keeps going up. But many people in Japan are saying that it's less likely. So they just try to get out of stagflation as much as possible. So this time they're not going to change much in terms of their monetary policy.
Right. Now, shifting our focus on the domestic front, the Fed's latest decision has resulted in a record high rate gap between South Korea and the U.S. Now, Professor Song, could you explain to us why will this affect the $1 exchange rate and why does it matter at all?
Actually, South Korean economy is not, it cannot be as autonomous as autonomous as Japan enjoys. As Professor Kim has mentioned that some Japanese Bank of Japan's control of the yield curve, particularly long-term curve. So that is conducted, Japan could conduct such monetary policy and keep the low interest short-term rate very low. The reason is because they would like to increase the domestic demand and domestic economy only. Actually, Japan currently focuses on the domestic economic growth rate, and also they are, even though their 13 months inflation rate has been above 2%, but on average it remains almost as much as 2%. So therefore, they would like to keep maintaining some relative high inflation rate, but then they would like to foster domestic economy. That's why the Japanese yen has become very weak, but however, still it is gaining momentum right now. Particularly for the Korean won and dollar exchange rate. Currently, I think the U.S. hedge fund and the U.S. capital market think of the Japan and South Korea as a kind of some reservoir, or just escape haven, some emergency situation. So in case of in the U.S., if the interest rate goes up, so they when they are a little bit concerned about the asset value, and they move their money out of and put into South Korea and Japan. That's why that is reflected in some exchange rate movement in South Korea and Japan, particularly. And previously, they would like to put those monies maybe in China, but China's domestic economy is very cautious and very slowly recovering. So that's why I think, even though the Korean economy is GDP growth rate is revised actually downward by almost 0.2% negative. And so currently 1.3% by ADB and 1.4% by the IMF in the most recent outlook update. They expect the South Korean economy recovery a jump in the next year, 2.4%. But whereas in Japan, this year 1.3% and remains in the next year 24 and ongoing 1% real growth rate. Therefore, relatively Japan and South Korea is regarded as some kind of some shelter to avoid the temporary shelter to help to keep the value of the uncertainty, avoid uncertainty in the U.S. market. So that's why that is reflected in the exchange rate movement in yen and recently in South Korean won.
Right. In related question, Professor Kim, the big concern seems to be the potential volatility in the exchange rate, which affects capital outflow. How big of an impact are we expecting?
Well, I expect that fluctuations are likely to increase in the short term, but as Professor Song pointed out, I think the rate hike was well expected, and also now the many investors view Korea as somewhat safer sort of like places to invest. So the effect is going to be relatively smaller. So not just the U.S. or the foreign investors, but the foreign direct investment by Korean investors themselves actually significantly increased over the last 5 years or so, as we know. So nowadays, Korean investors, for instance, directly purchase the stocks and trade their stocks and bonds of the other countries, especially like the U.S. or the Japan. And this can increase the demand for foreign currency just in the very short term. However, this investment and the assets that they hold will pay dividends and coupons. Therefore, the income flow actually can be positive. So even from the domestic side of investing to other countries, this may stabilize exchange rates to a certain degree. And I think that's actually a good thing, because it's going to just to make the balance of this diversified portfolios work to stabilize this exchange rate. And also, although the interest gap is an important determinant for the capital in and outflow, the investors always focus also a lot on the survivability and the sustainability of countries in terms of the investment, because it's very important that this governance risk or the risk is actually relatively limited when you invest. And in that sense, I think Korea is not a risky country among these the investing candidates nowadays. So in part because of that, I think the exchange rate, the fluctuation has been relatively more muted than we originally expected.
Right, so the impact could be rather limited, I should understand. Now, Professor Song, the big question now is what does this all mean for the Bank of Korea, which has decided to hold its key interest rate steady for the 4th consecutive time? What is your take on its next decision?
My answer is they keep hold it off or rather just to decrease the interest rate. The main reason is our economy currently is 1.4%, 1.3% because of some international trade and our government's some stance on the stance of diplomacy against the biggest market in China. Therefore, because currently Chinese economy, as I mentioned earlier, that consumers are very cautious, and then the second quarter GDP growth rate is less than expected. The reason is because they have experienced the COVID lockdown, but there is not much pent-up demand for the consumption because they are concerned about the international situation, particularly the conflict between China and the U.S. Therefore, the consumers are very cautious. Then, in the next year, as long as the world political situation stabilized, I expect the Chinese people begin to spend money and the pent-up demand will recover. Then we must ride on that situation. In order to do that, we need to change the stance against China and some other surrounding countries. And also, we need to pay attention to some Korean economy. Particularly, the vacancy rate is 3.2% in Korea, and the unemployment rate is 2.6%. Actually, this is not a good news for the income earners, because this means the income earners, may not expect some wage growth. So that without such expectation, then the consumption in the domestic market's demand or consumption is not to rely on to bolster the economic growth rate. Then we need some international trade. The situation should be improved. And so that's why I need to not only reducing the interest rate, but also we need to change some diplomatic stance against China. Then that is very necessary and policies to be adopted for the recovery of the South Korean economy for the next years, 2.4% economic growth. Otherwise, I think there is no chance.
Certainly, it's a complex and complicated situation. Now, actually, I want to ask the same question to Professor Kim. Do you agree with Professor Song?
Yeah, I agree that this basically, if you look at the data of the Korean the economist balance sheet, the only area actually that's lacking is the export part. And that part, I think, should be improving based on basically the increase in the export to more diverse set of countries. But at the same time, you don't want to lose completely the trading partner that's been important. So I think some balancing act is going to be necessary. And the Korean economy is not a strong shape, but I wouldn't worry too much about one or two forecast in making this judgment call at this stage, actually.
All right. Unfortunately, this is all the time we have for today's edition. Thank you so much, professors, for your insights today.
Thank you.
Thank you.
Thank you. Well, that is all for today. Thanks for watching.